Craig, I
Hi,
see
Ro-
you there. How you doing, buddy?
It's another day in paradise, brother.
Isn't it? Another day, another dollar, or I guess we could say a gold or silver coin if we wanted
Right.
to. So thanks for joining the conference. Glad to have you on a couple months ago on the channel for the first time. Thought we had a great conversation, and a lot of things that we talked about, I think, have started to come to fruition, whether we say fortunately or unfortunately. Of course, this morning, Jennifer and I had a talk about the Fed, the position that they're in, and what that may mean for our society. I didn't know, Craig, what are your thoughts on where we are sort of in terms of an overall society? And then after that, I'll turn you loose to do your presentation.
That's an interesting question, Rob. I wrote about that actually this week after watching, as we all did, the events over the weekend in Afghanistan. And, it's so easy to try to, because everything's so viewed through a political lens these days, everything, your health, the economy, it doesn't matter. Everything's, either you're a Republican or a Democrat or conservative, and there's never anything in the middle ground anymore. And so this is also viewed that way. But really, the way I look at it is it's just another knife wound, I guess, to American credibility and confidence. And then that ties right into the history of price manipulation, since Bretton Woods, because if you don't have fiat currency exists solely on confidence, right?
That's right.
If you're going to transact in anything, I don't care what it is, if you're a business and you're selling your product, or if you're going to save your wages from your hard work, you have to have confidence in whatever that unit is of currency, or you're not going to use it. And that's why the dollar was backed with gold coming out of World War II in the first place. And now, since it's just this free-floating exchange rate with all these other similarly worthless and devaluing fiat currencies, the only thing that backs them up is a confidence that somehow they'll be worth something tomorrow. And confidence is something that, it's a lot like Hemingway's thing about bankruptcy, right? I mean, how did you go bankrupt? Well, slowly and then all at once. You lose confidence in your monetary system slowly and then all at once. Witness Weimar Germany, or events that we've seen in Venezuela over the last years. And so I've been writing and talking about this for over a decade now, and things sometimes move at a snail's pace, sometimes they accelerate. And I think we took another step forward toward the end of confidence in just the past.
All right, Craig, I'm going to turn it over to you and let you do your presentation on history of gold market manipulation. Thanks for joining. We'll be back on in a minute.
Hey, okay, fantastic. And again, I invite everybody. I don't plan to use the full time slot, just listening to myself speak. So anybody that's watching this live, I know there's a chat thing there, Rob, right? People can send in any questions. It's something I actually do once a month with everybody at my site here, TF Metals Report. We have like a cocktail party on the last Friday of every month where we all crack open a beer or whatever and join each other on a Zoom call. And it actually still kind of amazes me that people actually want to hear what I have to say about their questions, but I'll answer any questions you have as long in the time slot that we have here. Why I offered to talk about gold price manipulation, Rob, actually, and again, as I just said, it all kind of ties together with current events today. But whenever I do seminars or big meetings like this is a topic I like to address, because typically I've found that attendees to meetings about precious metals and the like are typically a lot of times people that are new to the sector, kind of getting warmed up, just learning about sound money and how it works. And then they'll hear, you don't have to be involved in the metals very long to hear that the prices are manipulated. And then, you go down that road, and then people say, well, no, they're not manipulated. You're crazy. There's these traditionalists that follow the charts or sell advice that don't want you to think anything's manipulated, because otherwise what good are their charts or their advice if it's all just manipulated? But you have to understand that when we talk about price manipulation, it's not a conspiracy theory. It is actually a historical fact. And it's something that continues to say, hey, Rob, just, I guess late yesterday, we got word that the judge in Chicago who's in charge of running the racketeering case, the RICO case, against the 4 JP Morgan traders, specifically including their head of global commodities trading. That case is going forward. Okay. So it's not as if, again, this is just, we just sit around and complain, and whenever price goes down, we can't explain it. So therefore it must be manipulation. No, this has been going on for years. And coming out of World War II and Bretton Woods and the whole, actually any type of gold standard where you say, we're not going to allow, or we're going to fix the price at a certain level. Well, that's manipulation at its core to begin with, right? I mean, a market is where prices fluctuate based on supply, demand, buyers and sellers, that sort of thing. When you fix a price of anything, whether it's apartments in New York City or whatever, that's, of course, a price manipulation. So let's give you a little history here. A lot of folks listening, watching, may have heard over the weekend, seen something over this past weekend about the 50th anniversary of President Nixon suspending, as they said at the time, the dollar's convertibility to gold. Some call it closing the gold window. That's where you put dollars, your dollar to gold. And why countries doing that? Okay, well, we got to go all the way back to World War II. If you anybody that studied their history, or heck, even just last night, watching a Netflix series about World War II. I mean, the globe shattered. There was nothing left. All of Europe was a pile of rubble. Japan was a pile of rubble. China was nothing. Russia was desolate. The only functioning economy in the world at the end of World War II was the U.S. So in anticipation of the Allies winning that war and having to come up with some measure of some type of currency that would restore confidence, a meeting took place in Woods in New Hampshire, Vermont. I always, one goes up and one goes down. Anyway, 1944. And they decided that the U.S. dollar would be the global world's reserve currency in the post-World War II era. And that every dollar would be backed by gold to the point where the price was at $35 an ounce. So dollars, conceivably, you can fork them over and get gold. So if your currency has that type of back, okay, well, I feel good about it. So we'll use this gold-backed dollar, and we'll use it globally, and every country that's rebuilding can use it. Okay, well, that's fine. The U.S. had 1,000 metric of gold in their reserves. And Rob, I forget how to share my. Is there a button here?
It's going to be that little monitor-looking button at the bottom.
This one here,
right underneath you.
All right, let's allow it. And then I'm going to.
There we go. We got you.
You see that now?
Yes, we can.
Sweet. All right, James Henry Anderson gave me this last week out of a presentation he had a couple of years ago. This tells you everything I'm about. This explains graphically everything I'm about to explain to tell everybody. So the U.S. had hardly any gold reserves. See that, like in the 1930s, 6,000 metric tons, right?
Right.
And Rob, so you can hear me. You can be my live and in-person audience. What happened in 1933 and that caused our gold reserves to shoot up?
They stole the gold from the people. Is that what you're referring to?
Yeah, right. U.S. confiscated everybody's gold, right, or tried to. Right. So we peak out up there as World War II begins, just under 20,000 tons, give a little back and a little more. But coming out of World War II with the start of Bretton Woods, let's call it 20,000 metric tons, okay? And again, remember, to have this unit of account, this currency that the world can rebuild with and have some faith in, the U.S. dollar is now the reserve currency backed by gold. Okay, that worked out great. Worked great. You had the Marshall Plan, you had Europe rebuilding, global trade resumes, and over the next 10 years, the world global economy starts to cook again. Then came a problem. Beginning in 1956 and through 57 into 58, countries who, let's say France, England, around the world, that had rebuilt their economies, started using the dollar as a unit of exchange, and started to accumulate in their foreign currency reserves dollars. Okay, that's fine. But a lot of these countries, knowing that dollars are dollars and gold is gold, decided, you know, I think we'd rather have gold instead. And since you promised us if we had 35 of them, we could have an ounce, let's do it. So notice beginning, if you can see my cursor here, beginning here, which is about 1956, notice this precipitous decline of about 30% down here to 14,000. Rob, that was a scandal. You know, in 1957 and 58, we think of Elvis and Happy Days and stuff like that. Well, this was a scandal in Washington. There were hearings like you see now with the House, I don't know if there's a House Financial Services Committee or whatever it was back then. All these hearings. What are we going to do? Oh my gosh, we've lost 30% of our gold reserves. You know, if this trend continues, we're all doomed. That was the first salvo against the U.S. defending the $35 price. So we take a couple years off from 58 to 61. And in 1961, I'd encourage anybody that doesn't know this term to Google it. We formed with 7 other countries the London Gold Pool. That was the U.S. and 7 other countries pledging about 3,000 metric tons into a pool, a consortium, a cartel, whatever you're call it, using that physical metal to control, manipulate price so it stayed at $35, meaning that anytime demand was such for gold that the price rose due to that demand, then the gold pool would start dumping some of that 3,000 metric tons on the market to bring the price back down. Anytime price then fell below $30, the gold pool would buy gold back and bring it back up to 35. Again, now that's price manipulation there as well. Now the London Gold Pool worked fine until 1968, when suddenly they couldn't control the price anymore. It's got away from it. The London Gold Pool was exhausted. London closed for 3 weeks, like a 3-week bank holiday. And then they had to figure out what they were going to do from there. All right, I'm just referring back down to my notes here for just a second, make sure I'm staying on track. So what then happens? By just within a couple of years, gold rallies from 35 to 90. It's going like crazy. Nixon, again, faced with this ongoing demand. See my cursor showing this continuing fall all the way to 71. We're all the way down to just the 8,800 metric tons that we purport to have today. So this trend did continue. That began in 1957 all the way to 1971. And if you can clearly see, if Nixon hadn't closed the gold window, what was going to happen? Well, by about 1990, U.S. wouldn't have had any gold. So since 1950, been on a totally free currency system where nothing is backed by the U.S. dollar index, the greatest scam that has been put out there yet, because you'll read like today in the financial press, the dollar is up. Well, the dollar's up. The dollar's stronger today. Well, they're always quoting the dollar index compared to other equally unbacked, quickly devaluing currencies like the euro and the yen and the pound and the rest. And so if they all devalue at the same rate relative to each other, they don't move. And so today the dollar is a little stronger versus all the rest of them, but it's not stronger, right? It's just relatively speaking. Anyway, I digress. Let's now go forward. So now Nixon closed the gold window in 1971. American citizens are still not allowed to own physical gold until January 1, 1975. One of the ways that the American politicians decided, well, maybe we can start, I don't know if they'd ever be able to confiscate it again, but at least maybe we can start getting some gold back into the country is if we allow U.S. citizens to own gold again. Now, at the same time, we don't want them buying too much because that would draw down the physicals. You know, gold's going to spike if they buy too much, but we at least want to give them a shot to own it again. So January 1, 1975, U.S. citizens are allowed to own physical gold again. Rob, your next question. You got to play along, brother.
Okay.
We all know.
So I have a question.
I
have a question from the audience, actually, if you want to answer.
Oh, okay. Well, hold on. I'll just wrap this up then. I won't even ask you this. We all know that price is determined through futures trading at this point. The futures tail wag dog, right? Okay, well, American physical gold ownership was once again legal on January 1, 1975, when Did COMEX gold futures begin trading? December 31, 1974. And we now
no
know,
coincidence there.
through cables unearthed by WikiLeaks that that was all by design. 3 weeks before, a cable was found 3 weeks before, dated December 10, 1974, from England to the U.S., saying the dealers expect a formation of a sizable futures market that will be highly volatile, and as such should dissuade long-term physical hoarding. Wow. Huh. I'd say you just saw another example of that about 10 days ago on a Sunday night when the futures markets dumped at 6:45 Eastern on a Sunday night for $100. Yeah, you create enough volatility, people say, I don't want that. So the system still operates to this day. The banks profit from it. Central banks profit by having a perceived level of confidence in the dollar because gold isn't soaring. And again, my point in all of this, the idea that price manipulation is conspiracy theory is not even remotely true. Anyone willing to take the time to learn their history and study the facts will know that's actually historical fact. Instead, continues to this day. It will continue until the day comes when it will no longer be able to continue, like the London gold pool in 1968. So anyway, let's get to your questions. I could blather on about this, as you might imagine, for quite a bit longer, but lay it on me.
All right, so first question is, Craig, many discuss the effect the Fed raising rates in late 22 will have on PMs, yet to hear somebody address approaching potential Fed taper potentially this year, I think according to their meeting minutes. What are your thoughts on, will that be negative for precious metals if we taper?
I've been saying on my site and in other interviews I've been doing lately, I actually think whatever you're going to get at the Jackson Hole meeting next week, and then pen to paper at the September FOMC that's in 4 weeks, is actually going to be one of these kind of buy the rumor, sell the news things for the dollar, and a sell the rumor, buy the news for the precious metals. Now, how much we can turn things around still this year remains to be seen. But I'll remind everybody, we're all pretty frustrated, not just at my site in the summer of 2020. The Fed had rolled out all this QE, all this alphabet soup of, facilities in response to COVID. And the metals, the derivative price, even the COMEX had shot higher, but then it got sideways for about 100 days. And then once it broke out of its range above 1780, which is where we are now, we went from 1780 to 2080 in about 6 weeks. Silver in a range for like 6 years between 14 and 18 finally got above 18, 19, 20, and then went to 29 in about 3 weeks. So it's not out of the question. We can still turn things around this year, but for now, sentiment is just lousy. I think most of the buyers of the futures contracts, the hedge funds, institutions, and the like, are buying into this transitory thing. And believing that the real rates for the 10-year treasury, which are now negative 4%, they keep buying 10-year treasuries because they think, well, that real rates are going to go back up because the Fed says inflation is transitory. So once that all kind of shifts, again, that shift could come, like I said about confidence, and comparing that to Hemingway, that shift back of sentiment back into gold could happen pretty quick. We saw it again as recently as just last summer.
So we have now negative interest-bearing debt, corporate debt in the U.S. I read that story, I believe it was on Reuters the other day. Are negative interest, like not only nominal interest rates, but printed, real interest rates, but nominal ones, the printed ones, are they here to stay in the U.S.? Do you think we're going negative at the sovereign level?
Well, Rob, actually, this goes back to that June FOMC meeting too, where people first started talking about tapering. Remember the dot plot had changed a little bit and everything. And June 16th is when gold had peaked out this most recent time up around 1920. And we've been in the tank ever since. It wasn't so much the taper thing with hindsight that has really impacted the commodities and driven the dollar higher. It was the Fed deciding to pay 5 basis points on excess reserves that did it. And I interviewed Danielle DiMartino Booth, who used to work for the Dallas Fed. I interviewed her back in February, and we were talking about yield curve control and how important it is for the Fed to keep long rates from rising, thereby enshrining these negative real rates. And she said that's true, but the Fed also has a kind of a barbell problem. They've got to worry about short rates going negative. They've created so much cash. There's so many dollars floating around that there's more demand for short-term investments like 4-week T-bills than there is supply. And in May, the Fed actually, or the Treasury Department actually ran 4 consecutive 4-week T-bill auctions that printed at 0.000%. Okay, so we were getting to a point where even the officials, the money market funds, these banks with all their cash sitting on their balance sheets, everybody's looking for a place to park money. We were at very close to having negative rates enshrined in the U.S., even on Treasury debt. So the Fed, what they do in June, they suddenly start giving out 5 basis points on excess reserves. Now, it doesn't sound like much, but that's infinitely more than 0. And now you see this reverse repo thing. A lot of folks might be seeing those headlines every day. We've now almost permanently over $1 trillion in reverse repo demand every day. That's $1.1 trillion of just cash that is being, to use the COVID term, quarantined by the Fed on a daily basis to keep it out of circulation, to keep it out from being loaned out or whatever, and being parked at the Fed every single night for these paltry couple of basis points. That keeps demand away from things that would push rates negative. It also keeps that liquidity from being out there buying stocks, bonds, gold, commodities, and the like. And that's the biggest drag we have right now is, and since June 16th, is that that $1.1 trillion again today is being locked up and quarantined. I don't know if that'll continue forever, and I certainly don't think any taper plan that the Fed's going to announce is going to be significant or will change that.
It sounds almost like they're working against themselves. They're trying to withdraw liquidity from the system to, I guess, stop runaway inflation that we think that we're seeing. Even if you look at the CPI, I mean, we've had 4 straight months of really high CPI prints. Do you think they're going to be successful? Because you've seen the stress with the $1 trillion reverse repo, the repo market. That's the ultra short term. Then you mentioned some of the short term debt markets as well, and then eventually we're going to get into longer term. Is this like a sort of a wave sort of going to roll through the debt markets that the Fed's going to have a hard time dealing with?
Dude, this is why Powell makes big bucks, right?
Yeah, that's right.
Look, it's a systemic issue, and at the end of this entire argument is the fact that the U.S. government's running $3 trillion deficits now. $3 trillion. $3
trillion.
Dude, yeah, I
keep an extra trillion in my backyard, Craig, just in case I need it. I don't know about you.
Why not? Remember, you could actually stack dollar bills end to end, and a trillion of them would get all the way to the sun.
Yeah.
Right? Or what's $1 trillion? I could cut you a $1,500 stimulus check every 30 seconds, beginning at the birth of Christ, and I'd just now be giving you $1 trillion. It's just outrageous. Or Rob, it was just reported that the monthly deficit for July. Now, you can't just extrapolate these out because there's some months that the U.S. government takes in some cash, like April.
Yep.
But the monthly deficit for July was $300 billion for a month. God, when I was in college and Reagan was president, people were having strokes because the annual deficit was pushing $300 billion.
Right.
At some point, you've got to create cash so fast to feed this machine that you can almost not keep up. We got the latest tick data that shows cumulative treasury purchases month by month of all these different players around the world. Chinese, for the last 4 months, again, have been net sellers of treasuries. But rates have gone down. Why? Because the Fed is net buyers of $80 billion.
Yeah, that's exactly right. Monetizing our own debt. We have a walk-up question here, Craig, right here at the conference.
Beautiful.
Yeah.
I don't know if you can hear me, Craig.
So I'll ask your question.
Okay.
Go ahead.
Thanks so much, Craig. Great history lesson. Really appreciate it. The London gold pool, was it a physical market when they actually dumped the gold? Were they really selling to another counterparty, or was it paper?
Did you hear that question, Craig? So for the London gold pool, was it really a physical transaction, or were they dumping paper?
Yeah, there were no derivatives back then. That was, and again, that's why there are derivatives now. That's why derivatives were the answer beginning in 1975. Because there was not enough physical gold to go around at that price.
Right, right.
And that's why
They were and everybody was losing physics. That's the 3,000 tons were gone after 7 years. And see, and that's what they've done. And that's what in the end makes this even still a profitable, compelling thing if you wait long enough, because what has happened is finally is alchemy. Bankers and the governments have for now 47 years convinced the world that pretend gold is the real thing. Whether that's futures contracts, whether it's unallocated accounts, whether it's shares in the GLD that gives you price exposure. Rob, neither you nor I or the guy that asked the question can get gold out of the GLD. Only the banks, the authorized participant bullion banks can. So you've got now all of this alchemy that's taken place to give you exposure to price, not the real thing. If and when we swing back to the real thing, and you know the curtain is drawn back and you find out how much gold is actually there with clear title, that's when it's going to be, that's when there's going to be heck to pay. And the final thing about this gold standard stuff, you know, you can, even the Fed's own charts, if you go to the Reserve Bank, the Federal Reserve branch of St. Louis has all that data and all the charts on their website. They call them Fred charts, F-R-E-D. Anybody can just Google Fred charts. You'll go right to the site. Even all of their own research shows the beginning in 1971 is when all the problems in the U.S., the crunch of the middle income people, the income equality, the wealth inequality, all of that began with 1971. And so economists and people that have a stake in maintaining and propping up the current system always say, well, you can't go back to the gold standard. There's not enough gold. There's plenty of gold. It's just you have to price it at the right level.
Exactly. It's all that derivative paper sitting on top that people think there's not enough gold, and it's determined by this derivative paper, which is just a game of shorting and taking profits, shorting and taking profits over and over again. But once you get rid of that derivative complex, gold should reset to its price. So what do you think? Last question for you, Craig. What's going to reset that derivative complex, if anything?
It's a loss of confidence. You know, the people who play the game of derivative contracts and unallocated accounts and ETFs, they play it because they have confidence. Well, I can get my metal out of that unallocated account anytime. They lose confidence in that. That's a whole other story. The futures, people that trade futures contracts or forward contracts in London, they lose confidence. If the central banks that have leased their gold through the biz, if they lose confidence, all in confidence. And when confidence fails, it usually happens pretty quickly, like a bank run. So that's what that. But you know, why would anybody expect me to be professional? I go by Turd Ferguson.
Thank you so much, Craig, for joining the conference. Absolute pleasure to have you here. Where can people find you if they want to reach out to you with your newsletter and your service?
Right there, man. It's only $15 a month.
Yep.
The community, it's actually, my community is worth that alone. Been around for about over a decade. Please, I mean, if you're interested in this stuff, this is a great place to start. You can go month by month and quit if you don't think you learned anything. But I think anybody that does join, they seem to like it.
Thank you so much, Craig. We appreciate it very much for joining. Next, guys, we are going to have our